Let's go ahead and get started in our webinar. Like I had mentioned, today's educational webinar is going to be everything loan servicing with our special guest, Enrique Flores of Servicing Pros. Before I introduce Enrique, though, I just want to say thank you for everyone that's logged in today and going to be listening to our webinar. For those that couldn't make it or want to go back and listen to the webinar again, it will be recorded and we will be posting the webinar on the TaliMar Financial YouTube channel. If you haven't got to the YouTube channel, the TaliMar Financial YouTube channel, we post a ton of great content about trust deed investing, mortgage fund investing, and really just generally about the private lending industry. So go ahead and check it out if you haven't already. And then when you're there, definitely subscribe because we're posting new content all the time. So as I mentioned, this webinar is part of a series of educational webinars that I've been putting on for the last couple of months. We've got some really cool industry experts on our prior webinars. I'm excited today to introduce Enrique Flores of Servicing Pros, who agreed to come on. Actually, I ran into him, as I mentioned before, at the American Association of Private Lenders. So Enrique, hey, thanks for coming on.
Thank you for inviting me on.
Yeah, can you just briefly give people a little background on yourself and a little about your company?
Sure. I'm going to age myself since I've been a licensed real estate broker since 1987. As far as servicing, though, that's the last.
You don't look it at all, though. I'll tell you that. You do not look it at all.
Yeah, like you go, wow. But yeah, really, real estate has been part of my entire life. The last decade has been more on the servicing side, loan origination side, and I had the opportunity after being president of a couple companies to venture out on my own and started my own company called Servicing Pros. So,
well, congratulations on your new venture.
Thank you.
Yeah,
so very excited.
Yeah, no, and I'm excited to see you grow. And again, I'm glad I ran into you at the APL meeting. I think I've known you maybe 10, 15 years. I always tell a funny story. When I first got into the business, I tried servicing my own loans, and it didn't go well. I was very green about what I was doing, and actually, I reached out to you and your former employer there, and actually had, I think, my first loan serviced by a third-party servicing company was serviced by you. And I always remembered you were always very calm. Like I was like really nervous about the loan, in terms of like, am I going to get paid and whatnot? It was like my first loan, and you're like, hey, Brad, we got this taken care of. So thanks for being there and being the calming spirit in my life on my first loan.
You know what? That is how I do things. I'm the calm guy. I'm not going to go out there and wow you with my
no, I got it.
My charisma, but the calming thing just I guess in my accounting mind that's like, okay, we're gonna get all this done. I'm gonna get this done and not worry about the other stuff.
So, and you probably get that obviously from a lot of investors too. So trust deed investors that maybe done their first trust deed and putting it onto a servicing platform. I imagine there's a lot of hand holding there.
There is a lot of hand holding. I mean, yeah, for the first time investor who comes on board, I get a lot of very basic questions. Okay. And actually like doing that. And always the caveat is like, okay, you should know this already. Yeah. However, these are some points you should know about.
Okay.
So yes, I get that a lot.
So before I get started in some of the questions that I have for Enrique, I always tell the attendees, I want this to be more less Q&A between Enrique and myself, and more of a fluid discussion. So please use the question button at the bottom. I think for most of it's at the bottom, some that's at the top. Feel free to ask questions. I always say that if you have a question, I guarantee someone else that's attending the webinar also has a similar question. Also, Enrique and I are in the industry day to day. So we know terms, we may throw around something that might not make sense, maybe an acronym or an industry term that you don't know. feel free to stop us and say, hey, can you clarify, what you're talking about? So use that question and question button there. And once I see the questions start rolling in, Enrique, I'll go ahead and manage that and ask you those questions. So let's get started. Enrique, I'm going to throw you a softball one here. What is loan servicing, and what would a loan servicer typically do with a trustee investment or mortgage investment?
Well, that's an easy one, right? Yeah. I mean, it's as easy as we do the accounting and reporting of your loan. That's
Okay.
really the general terms. And the accounting part deals with onboarding the loan,
So,
giving
a perfect
statements.
example. When you say onboard, what does that mean?
Right. These terms come out,
Yep.
naturally to me. So, and that's to all servicers. Onboarding is where you get the documents from the investor or the escrow company, whoever they decide it's going to send us the loan. They submit the
Okay.
loan to us. We get the note or the mortgage,
Yep.
the deed of trust,
Mhm.
and the final settlement statement. And then we need borrow information, lend information, and we put it into our system. We
Okay.
upload it into our system, and we make sure that our system correlates with what's on the note and the deed. So that's
Okay.
the onboarding process, is taking the submission and making sure it reflects in our system to what we received.
Okay. Okay. So what I hear kind of though, from a loan servicing perspective, you're responsible for managing a loan, collecting the payments, updating the investor on the performance of the loan.
Correct. Right. So obviously that the note, whatever we get from the investor,
Mhm.
I put interest and we manage that. We manage it to the note.
Okay.
If after the fact it warrants doing this, well, it's not in your note.
Okay.
And then then that's where it comes in. Like when I get something new from a new investor, I try to tell them, I try to look it over and say, okay, by the way, this is the perfect time. If you need to do any changes or inform bar of anything, this is the time to do it. It might be too late at that point, but
Okay.
yes.
So what would be the pros and cons of a trusted investor working with a professional loan servicing company like yourself? So someone that services debt versus kind of doing it on their own. So going out and trying to collect the payments from the borrowers
Right.
themselves.
So, you know what? There's a lot of people who want to do everything on their own. The pros for them are, you control everything. You control what you get, what the borrower gets. You control that on your own. However, not your job, your goal as a loan originator should be originating loans. That's where you make your money.
Yeah.
And where we come in is we handle all that day-to-day operations of managing that loan. So once once you originate it, it comes to us. And at Servicing Pros, what we try to do is be part of your brand, right?
Okay.
Because once you give it to us, if we start doing a really bad job, or if we don't do what we're supposed to do, then you look bad.
Yeah.
So that's really the key is, first, we're part of your brand. And second of all, is to follow your note and to do all the reporting, all the compliance, make sure that borrowers informed of their payment statements. If they're late, send late notices, call them, all these things that we do. I mean, we just did an upload or onboarding of 500 loans.
Yep.
And we reached out to every single borrower and every lender at least 3 times each.
Okay.
So for you as a loan originator, you should be concentrating getting new loans and not worrying about calling every single borrower. Your job with that borrower is done until the cycle turns into a payoff, and then okay, let's reach out to this guy again, and then let's go. Let's do this whole circle again.
I would 100% agree with you, Enrique, on that. From that standpoint, is that if you are originating or investing in trustees, really your focus should be on originating or investing. Reviewing the trustees. The servicing portion of it for a very low cost, you can have a company like yours do the actual documentation, statements, tax end statements, processing incoming payments. And then most importantly, especially if you're in the state of California, is to ensure that you're following California regulations when it comes to servicing debt.
Correct. Yeah. I mean, when you say, am I going to save money by using a loan servicer? I mean, we make $20 a month.
Yeah.
That's nothing.
Yeah.
We do share in some of in other items. However, for $20 a month, you have somebody who's committed, and in our case, we're accountants that is going to do what our job is to service a loan.
Yeah.
Like I said, right? And your job is to, not your job, your goal is to get more business to send to us. And that there is, it's not that much money. If you have, if you become really big and you have 10,000 loans, you can have your own staff and take care of it, but for a small, I mean, we have a couple investors who have 500 loans.
Yep.
And they use us because they do not want to do what we do.
We have we have almost 100 loans in our portfolio. And people have to understand that you would have to buy all the software. You'd have to also bring in somebody and train them up on the software. And then most likely, have available office space for them as well. So you offset the cost of having a third party service your portfolio. And then for a fund manager like myself, or have to go through that internally, and having a third party servicing company is always the way to go in my thought process there. So I got another question for you. What is the life cycle of servicing? So from so now I've closed on the loan, I funded my funds into escrow, we've closed. What happens typically with a servicer at this point?
Well, I already mentioned the onboarding of it.
Yep.
So now the borrower comes into our system. We send their welcome letter. We call them. They make payments, and the perfect borrower makes, if you have a 12-month loan or a 24-month loan, they make 24 perfect payments. And right before maturity, when the note's supposed to be paid off, they send a request a payoff demand through their escrow company, and they pay it off. We do the reconveyance, and now that loan is completely and compliantly taken care of. And now this borrower is off to buy another property, and that's where you come in again. So that's really the
never happens. Enrique,
it never happens that way.
World, that would happen, but we know that never happens.
It never happened.
So what can a trusted investor, mortgage fund investor, or broker, what kind of issues do you see on the front end that you can easily stay away from? Like, what are the mistakes at the time of close that always kind of roll themselves into the servicing that you can just, that are quick fixes that you don't need to make?
Right. So the quick, some of the things that there's some lenders and or brokers that want the borrower to pay for everything.
Okay.
And they just commonly put borrower to pay all servicing fees. Well, that's not going to fly.
Okay.
It might, we could try to do it, but then I go ahead and create a different document that says, by the way, borrower, you are paying for these servicing fees, and this
so they're making their monthly payment as negotiated on the note,
right?
And then you kind of slip in this, hey, by the way, you're paying an extra $20 to pay for the servicing of your own loan.
Correct.
And it never goes well.
It never goes well. No, it doesn't. The minute that you start, charging them, like, wait a minute, I'm paying the lender already this much money in principal interest. Why am I now paying you? They're the ones set up.
So investors don't be greedy on that.
Investors do not be greedy on that. It's $20. If you do want to, if that is what you want to do, just make sure you cover it. You disclose it really well. One of the things that I've had some lenders do, which is really actually a good thing, so I'll give you a good tip, is that they put our ACH form into their loan docs.
Oh, we've learned that lesson.
So as they're signing.
So real quick, explain what is ACH and why would that be important?
Okay, it's called automated clearinghouse. It
Okay.
is
Actually, I
part.
didn't know that. I've always been asked, what does ACH mean? And I've
Oh,
never known what ACH physically means. Okay.
right. So yeah, automatic clearinghouse, and it
Okay.
is part of the federal banking. Oh my God. Anyway, it's
Okay.
it's regulated by the Fed, and what that does is that every month on a specific day of the month, they're gonna get money's gonna get pulled from their account
Okay.
to pay your loan, your
Yep.
note, and that makes it way easier because we do have clients who are on bill pay. And bill pay at Wells Fargo, for instance, is they take it out of your account and then they put it in the mail and drop it off, and away it goes. 7 to 10 days later, we get it, and borrower's calling, why haven't you apply my payment and take it out of my account? I go, well, you sent it through bill pay. That's not the way to do it.
So
Uh,
electronic withdrawals is the way to go.
electronic withdrawal.
We went that way about a year ago. We required it on our loan. And now we're requiring it on the first of every month.
Okay, that's even more. Yeah, because most people, they set it up. What's my grace days,
Yeah,
right?
great grace period. Yeah.
And grace period means the amount of days that you're allowed to make a payment
Yep.
without incurring a late charge.
And usually that standard is like 10 days. Is that
It is for a non for a business purpose, commercial or investment property. It is typically 10 days.
okay?
If it's a consumer purpose loan, it's 15 days.
Oh, really? Okay. I did not know that.
So consumer purpose loans are governed by the CFPB, Consumer
Yep.
Finance Protection Board, and those have way more compliance things.
Okay.
And one of them is a 15-day grace period, which is a federal thing.
Okay. Let's jump right into that subject as you
Oh
speak
no.
about consumer versus business purpose, because that's a conversation that always comes up. I don't do consumer loans because of the regulations, but what is the true definition of a consumer loan?
The definition, a consumer loan does not have to be an owner-occupied property.
Yep.
What it
And
means
that's
is
important.
that's important. What
Yeah.
it means is that the funds being used for this origination
Mhm.
are for a consumer based purpose. In other
Yep.
words, I'm going to buy a car. I'm going to finance my kids' education.
Yep.
I'm going to go on vacation. I'm going to do whatever it is that it's consumer related,
Even if it's on an investment property.
even if it's on investment property.
Yeah.
Right. So
Yeah. Too often we get calls and that says, "Hey, Brock, I've got an investment property. I want to refinance, cash out." And the first question I ask, "What are you going to do with those funds when they cash out?" "Well, I need to pay off some credit card bills." And right away, that's no.
correct. So now, if you are doing it on an investment property, and you as a loan originator should follow what you just said and say, it doesn't work. Because a lot of loan originators, what they'll do is like, well, it's a business purpose loan because it's an investment property.
Yeah.
They'll have the borrower sign it. You know what? If it's a perfect loan, if it's a perfect borrower, you have no issues, nothing's going to happen to you. The minute that they stop making payments and they say, you know what? It wasn't business purpose. I used it for my own personal needs. Then you're in trouble, because
Even if they sign every disclosure under the moon.
even if they sign every
Yeah.
disclosure on the moon,
Yeah.
right? And I tell, so typically I tell people who are doing owner occupied business purpose loans, and they have the bar signed the business purpose addendum, business purpose rider, business purpose certification, all that is signed, and in their paperwork, I tell them, by the way, yes, most of the time that's gonna clear you until something happens.
Yeah.
That it's no longer the case. And we
Yeah,
have had a bad experience with, and I actually fired a lender that used to do that all the time. It's a 85-year-old grandmother who needed to pay off all her debts, and they got a loan with this lender, and they said, no, it's business purpose. And sure enough, she came back and says, well, I don't know what they're talking about. I just signed away.
Yeah.
And they got in big trouble. So don't,
Don't go down that
do things
route.
right.
Yeah.
do things right. Yeah.
Okay. So, but back, okay, so let's go back to servicing. We were talking about the life cycle of the loan. So we funded the loan. You gave some tips on, things you can do to set up the loan so you have as little kind of issues with the borrower. One being, don't make the borrower pay for the servicing fee. That's one. Um, so, and then also, obviously make sure that it's a business purpose loan, truly a business purpose loan,
Right.
if that's really what it's going to be, because that could be an ongoing issue. So, what do they do next? They submit the documentation to you, probably included a form, some type of onboarding form.
Yeah, so we have a couple ways, and most servicers have a couple ways of getting the loans to us.
Okay.
The best way for us is to go to our online submission form, because it asks you all the right questions, and even that online submission form is going to ask you some questions that maybe you didn't know about, whether it's this 360, the accrual basis, the accrual methods, and all that good stuff, right?
Okay.
So it's part of our onboarding online form. But then I have people who, like, I'm not very good at computers, so can I just dump all these documents on you? And I go, well, you can. However, I need at least all these things, and it's a manual process versus an online process.
Okay.
And for people who are technically savvy, I even have a different way of doing it, where they have their own Excel template and they could just fill out and give it to me, and I'll upload it, everything.
Okay.
So there's different ways of getting it into our system, from as manual as here's all the documents to our online form, to special ways of getting it done. I'm in the process of doing an API that'll push stuff into our system. That is still a couple months away, and that's for somebody who's really technically savvy about doing it. Okay. Right.
So what documents then are typically required? So we talk about like an onboarding form, but I know you've got your promissory note. I imagine you've got your deed of trust.
You got your
what other documents would an investor be submitting?
So when this is a brand new loan, you have the deed of trust, the note of the mortgage, the closing statement.
Okay.
The closing statement is really important. It tells us when interest starts accruing. And then once we get that, we do need borrower and lender information. And then we need W-9s.
Okay.
For both. So
for both sides.
And that comes into play when the tax reporting comes into play at the end.
Okay. So now we've submitted the documents. It's on your system. One thing that is always kind of trips us up at close, and you got to be very careful, is typically the first payment usually is a partial month's payment at close. There's those funds that the borrower is prepaying. So if you're closing on, let's say, January 15th, the borrower to close will pay for the interest accrued or whatever the payment is from January 15th through the end of the month. And then those funds have to be forwarded off to you.
Right. So by the HUD, it's actually the closing statement or the settlement statement that escrow provides. And that'll tell me what day that loan actually closed. So if it closes on the 10th of the month or the 20th of the month, the escrow company usually collects from the 20th through the 1st of the month.
Okay.
That's called a prorate or odd days interest. One of the things that is in California is that sometimes your broker will say, wire this money to escrow while we're waiting for it to close, because when it closes, I want it to be there right away. So if you send the money early, you are not collecting interest on that money until it actually closes.
That's interesting, because one of the frustrations I have is, let's say we're ready to close on a Friday, and last minute issues rolls that loan closing over to a Monday or Tuesday. Well, I've just wired my funds in, but I'm not earning interest on that funds over the weekend.
Right. So in theory, so if you do the escrow loan closing package correctly as a loan originator, because what you have to do is, before it gets to me, you have to make sure that all your pertinent information, request, whatever that you want, requests for insurance,
Yeah.
requests for, taxes, if you're going to do impound accounts or escrow impound accounts. All that stuff is part of your escrow closing statement.
Real quick, escrow impound accounts. What is an escrow impound account?
So that is where the borrower is making not only payments to principal interest to pay down the loan,
Yeah.
you are requiring as a lender for that borrower to send us extra money
Okay.
on a monthly basis to pay for their property taxes and or their insurance.
How
So
common is that?
it is, well, right now I'm going to say it's really common because, like I said, the last client that he came in with 500 loans,
Yeah,
all
yeah.
500 have it escrow and
Oh,
pounds.
they all have escrow,
They all have it,
and insurance and
right?
taxes. Okay.
But aside from him, rarely
Really?
for the
Okay.
private investor.
Okay.
So that's one thing that it's really up to you as a lender to do it.
Mm-hmm.
If you don't want to do it, then you don't have to do it. So
Okay.
if you do consider, if you say at the beginning, you say, I want escrow impounds.
Okay.
Well, part of having escrow impounds is if they don't pay, then you as a lender have to advance
Okay.
to make payments to property tax or insurance
If they're not paid.
if they're not paid,
Okay.
and because the borrower's not making payments.
Yeah.
That is one of the negative things about an escrow impound account is you set this up because you want to be protected. Well, the minute they don't pay, we still have to pay because it's part of the agreement.
Yeah.
And that's another thing that most would understand is you can, as a lender, say, I don't want this anymore. You have to tell the borrower, of course, but at that point now the borrower has to make the payments themselves.
Okay.
So, but that's a little bit tricky. It's
Okay.
on consumer purpose loans, you can't do it, but on a commercial investment property, you can.
Okay.
So that's where that is. They're making monthly payments that are collected with a 2-month cushion.
Okay.
That when the taxes come due and insurance comes due, that we have enough to pay those. So just as an and this is more of a tip for us as a servicer of what we're dealing with right now,
Mm-hmm.
is whenever, well, California has insurance costs going through the roof.
Yep.
There's last year insurance.
It's even difficult to just get insurance. Forget about the cost.
Even difficult to get insurance, correct? So we've had about 5 cases that for this month alone, where the borrower's escrow impound account is short, and that is because their policy went from $1,015 a month, a year, to $3,000.
Oh,
It
wow.
is that crazy.
Okay.
So they're asking me, well, we've been paying monthly for this. I go, well, yes, you have, but this is not a standard thing. This is whatever you get from your insurance company. So
yeah.
And that's where we come into play. We're notifying the borrowers, say this is what's going on, and this is why. We're collecting the shortage from them, and hopefully we do the good, great enough job to collect it from them, so that we don't have to go to you as a lender and say, by the way, you have to advance.
You need to cover the difference. So that brings up another question. As a servicer, are you checking to see if taxes are actually paid? So let's say there is no impound account. Are you checking to see if the taxes are paid and the insurance is current?
No, not as a regular common servicing function.
Okay. So yeah, that still is a responsibility of the trustee, mortgage investor, or broker, whoever,
correct.
To make sure that
yes.
that insurance
so,
is, yeah.
Yes, correct. So you as a investor who originates loans, you want to make sure that the insurance is paid.
Yep.
You want to make sure that their taxes are paid. So that is why some opt for the escrow impounds.
Okay.
However, some servicers do what's called insurance tracking and or tax tracking. One of the things that we really don't do tax tracking at Servicing Pros. What I recommend that lenders do is just get a tax contract, because what that happens is that somebody like Loretta or CoreLogic, when you get a contract and it costs about a little bit over $100 for the life of the loan.
Okay.
And they will tell you the borrower hasn't paid
on taxes.
Okay,
interesting.
Luckily on taxes, you have 2, 3, 5 years before something bad happens. They could
Yeah,
stop
yeah,
paying
yeah,
for 3 years, and you're not gonna fear that they're gonna take it away
yeah.
from you. For insurance, that's a big thing. So we do insurance tracking where we make sure that there's always insurance on the property.
Okay.
Uh, we are in the process of getting a program where there's automatic force placed insurance,
Hmm.
and that's probably 6 months away. We're still a little bit too young
Yeah, yeah, yeah.
in our new company. However, that's really what I want to do, is do automatic force placed insurance. What that means is that the minute that the bar doesn't get insurance, then I'll tell you as a servicer, if you have insurance tracking, this bar doesn't have insurance. And then
Okay.
I'll refer you to, there's a couple companies that specialize in force place insurance. They send a letter to the borrowers and says, by the way, this is a compliance issue. And then they'll get coverage.
We
What's
were chatting a
important
little
there,
about that
right,
earlier before the
right,
webinar. Okay.
yes.
So yeah, and
That's
I'm actually going to
important.
have a full webinar on force placed insurance. So we're going to have an expert on force placed insurance come in and talk about it, because it is
Perfect.
something that, especially with what's going on, you mentioned what's going on in insurance today, that you're preparing yourself to work with the borrower to identify another carrier if their policy gets canceled.
Correct. Yeah.
All right. So I didn't mean to cut you off, but I wanted to get into this subject because it's important, because we have a lot of trust deed investors that do fractional loans. Can you tell us what a fractional loan is, and how does that play in for a trust deed investor?
So you have, this is more for the brokers out there, uh, because really, in order to do fractionalized loans, you need to be a licensed broker,
Okay.
or a fund manager that's has an exemption or is SEC compliant to be able to sell this investment to somebody else. So a fractionalized loan, in its basic terms, is there's one borrower and there's 2 to 10 lenders on the loan.
Okay.
Somebody sets it up, and if they set it up correctly, then you as an individual investor is going to get what's called LPDS, which is a lender purchaser disclosure statement. That's governed by the state of California, that you need to be aware of what this investment entails.
Okay.
You need to be accredited in not so much as a fund manager, but the loan broker should know that you know what you're doing.
Yeah.
So it is called a multi-lender loan,
Okay.
fractionalized loan. And we typically want one point of contact, which is maybe the broker or the majority lender.
And that's what's important when you do these, because we were doing fractional when I first started this business. This is kind of how we got started. Is we would take one loan and we'd go ahead and find an investor for that loan. But as our loan sizes got a little larger, where we were doing $100,000 loans, we quickly moved up to $500,000 loans, and you just didn't have investors that had $500,000 sitting aside. So I may get, we were getting maybe 5 investors per loan, so each one was putting 100,000 in. It never was exactly that, but 100,000 in. But then in most cases, you would have somebody that may own, 55% of the loan, and the other remainder investors were, didn't have a majority interest holder, and that's where the complexity comes in.
Correct. Now, another wrench into that is where the broker decides to get an interest spread.
Okay.
So the bar is paying 11%, but he's going to sell this note to multiple lenders at 10%. So they have a 1% spread. And so what we do as a servicer is all those parameters are put into our system, and as the bar is making payments, we'll give that broker their 1%. We'll give their lenders their percentage due of the payment. And so and then we'll send them reports of all of that. Our portal actually has that as well, and it'll actually tell you who the other lenders are as well, because it's part of disclosure. All lenders need to know who's in a note with them.
So what can go wrong in a fractionalized loan?
where
And
there's a
remember,
really
we only have 60 minutes here on this
right.
conversation. So blow through it pretty quick.
Yeah, the biggest thing is well, I'm gonna give you the basic biggest thing is at payoff,
Okay.
right? As a servicer, I can, with my servicing agreement, say, well, 10 lenders on this loan. I'm just gonna send a demand to the escrow company, and this is what they're gonna pay me to close out this loan, pay off this loan.
Yep.
I don't really like that because this loan might have other things like forced place insurance that you didn't tell me about.
Yep.
You've increased the loan, you did a modification, you did something to this loan that you didn't tell me about.
Okay.
And that's really, really important because what I do is I send this payoff statement to 10 lenders.
So what's
And
happened here is borrower wants to pay off the loan. The borrower is reaching out to the servicer, Enrique, and Enrique is sending in a demand telling the borrower how much they owe. But he's got 10 other lenders he's kind of speaking on behalf of, right?
right.
So you're hoping that there's no other cost that the lenders didn't tell you about or something different that you should be collecting for because, well, you don't know.
Right. What I don't know, right? So I do send it out to other lenders, and most lenders sign away. Obviously, the majority lender knows if there's anything going on,
Yep.
but there's sometimes, and that's the biggest thing is the one with a $5,000 portion says, "I don't want to sign this because
So you're
I
trying
don't
to
want."
get signatures from all 10 lenders and not even trying to do that, but in a timely manner.
Right. So it does get to a point where that one lender doesn't want to sign. I would still send it with my service agreement, unless there's something that I know that if there's a leak, type of things that I might not know that I need to know is, there's a lawsuit. You're suing the borrower. They're suing you. There's legal fees. There's all kinds of things that I may not know about until you tell me. So that's really important for always inform the
So
service.
payoff demands, make sure everybody's on the same page and they quickly sign that demand and get it into escrow.
Right. And there's
It's like
another
herding cats.
exactly. Another one is and we've had some lenders says, well, I don't want the borrower to pay off because I like having my monthly check come in.
I've had this happen. I know where you're going.
Yeah. Like I'm not going to sign that payoff because I don't want the borrower to pay off. Like, well, California says that if they want to pay off, they can pay off. It doesn't mean that they're,
That was an awkward conversation that I had with the
yes.
lender. And I'm like, well, I don't even know what to say. Like, you cannot not accept the money.
Right. Right. So that's where people put prepayment penalties or interest guarantees or something of that nature.
Okay.
However, that is really and then the final one is where the borrower is late, not even late a month, and there's that one investor like send them to foreclosure.
Yeah.
Yeah, you know what? So yeah, it's having 10 different personalities, and I keep on saying 10 because in California, 10 is the maximum amount of lenders you can have on a fractionalized loan, unless you have a special license to do more.
Okay.
So if you send me a loan with more than 10, I'm going to ask you, are you because then it becomes syndication.
When I first started this business back in 2008, I had an opportunity to it just randomly sublease the space from a private lender that unfortunately didn't make it through the downturn. And they had set up loans with hundreds of investors. And it was a mess. These were big land development projects with hundreds of investors. It was underwater. Probably the investors were better off if they could get them all together to kind of keep this loan going because at some point the value of that land was going to come back, but it wasn't going to happen. You weren't going to get every investor to chip in their percentage interest in the loan to keep the loan going. So I think at that point, that's when the state of California stepped in and said, hey, you can only have a maximum of 10 investors per loan.
Correct. And it makes it for fractionalized type of loans, that's really about the max that you should be able to go anyway because of all these personalities, of all these ideologies.
And don't even get me started with construction loans. So when you start to talk about fractionalized construction loans, so that's something to
Yes.
really take into. I would highly recommend not getting involved in a construction loan if it's a fractionalized note. But if you do, just know that am I right in that the construction proceeds have to be held by a third party fund control provider or service provider? 100% of those construction funds.
Correct. On a fractionalized loan, yes, you go to a fund control company. We do have holdback loans here.
Yep.
I don't call them construction holdbacks here because we don't do
Fund controlling.
fund control, right? So we do
yeah.
holdback control,
Okay.
and it's up to you to then say release the funds and do draws. And we do that here, but we don't do your typical construction fund control.
So another thing that I learned again when I first started the business was there were fractionalized loans where a broker would commit to a construction loan with a borrower, not having all the proceeds available for the construction. So the intention was, hey, when you needed the next draw, we'll go get the money. Okay. And it usually was never a problem. They could always get the money at that point. But when 2008 hit, nobody was investing in real estate. And so you had a borrower that may be performing on their construction loan, ready for the next draw, but the broker wasn't able to provide them that construction funds.
That is, you know what, that is,
and it's unfortunate.
Right. That's one of the main reasons why you need to have it in fund control, why you need to have it with us, so it's readily available to them. And a little bit on that same point is, if you do have a holdback loan, you can't charge interest on the full amount if you're holding it yourself.
Yep.
Right. So you have to send it to a fund control company or us to hold it in escrow in that point, because now you are losing opportunities of use that money somewhere else. So at that point you can.
Okay. So let's go, back, kind of circle around. We were talking about fractionalized loans, the pros and cons. Cons being, look, you're kind of involved in a loan with other people, may have different personalities, different objectives. One way to kind of reduce the risk is, number one, know your other investors. So maybe it's friends and family you're investing with. Number two, take the majority interest in the loan, because then you really have the final say on what's going to be done with the loan. Are kind of the two main, or you have a very good relationship with a broker and you're confident that they're going to be able to kind of circle the cats, so to speak, and get a decision made amongst all the investors.
Right. Yeah. So we have brokers who kind of serve as a master servicer per se, and we're doing sub-servicing for them.
Yep.
And what that means is that they control the transaction, and because they have a contract with those investors to do that, right? So that is important to know. The broker controls it, or the majority note holder also controls it.
Okay.
And that's per California regulations, that they don't, once you have 51%, you can control what it is.
You actually jumped right into the next question, and that is that kind of master servicer arrangement with either an individual trusted investor or mortgage investor, or fractionalized. Can you go into a little more again? So that's how we operate, or we did operate when we did fractionalized loans, is that we were the master servicer. Borrower was always corresponding with us, even though we had a third-party servicing company, was always corresponding with us and not all the other lenders on the note.
Right. So that's, you kind of described what it is, right?
Yep.
It's you're a master. So you are, in theory, the servicer of the loan. Mm-hmm. And we, as a sub-servicer, what we're doing is just the accounting and reporting of it. Mm-hmm. However, and I get this question a lot, and as a servicer, you have to be licensed to do that as well. California, luckily, if you have a broker's license, you can do it. So, okay. But there are some states that you need to be licensed to be a servicer.
Oh, really?
So just, yes.
I didn't know that. Okay.
So that's where you say, well, I don't want to be the master servicer. You'll be the master servicer, and we still talk to these people. And when we do have, do not call arrangements with some
Okay.
brokers and some investors. So they want to be the ones to talk to these people, and we're fine with it as long as they do that and they let us know that they're doing it, because we don't want the investor, 11 days in when on the 10-day grace, jumping over a fence, knocking on the door, says, "Where's my money this month?"
Yeah.
And then you're not being compliant, and then that's where we come in, right? Like you can't go out there and bully people. So that is really is knowing. That's where the compliance issue comes in, is knowing when or how to talk to the borrower when they're late.
Okay. All right. Here's another question that comes up a lot. Investing out of state. So let's just say you're California resident and you're investing in Nevada.
Mhm.
What are things investors should be considering? What are the pitfalls of when you're investing out of California? Then what are the pitfalls if you live out of California, investing back into California on trust deeds?
Well, that's a loaded question. You know what? All this goes to the origination of that loan,
Okay.
and every state has origination rules.
Okay.
So as a loan originator, if you're going to Nevada, you better make sure you're licensed in Nevada.
Yep. And
Because
I bring up Nevada because they will come after you.
Yeah, Nevada absolutely will. Washington, Oregon absolutely will as well. We stopped servicing in Michigan because Michigan definitely will go after you.
Really?
Yes.
Okay.
So it's every state has their own origination rules, and you need to make sure you follow those. Just
So
because
you as
you're
a
in
trustee
California.
investor need to verify the broker putting the loan together for you
Correct.
is licensed to do so in that state.
Correct.
And if you're an investor direct, you better be licensed.
Correct. Right.
Wow.
So
Okay.
there's a lot of states that have they don't have regulations for commercial or investment property.
Yep.
So that's the minute it's owner occupied, just business purpose rules don't come into play there. It's if it's an owner occupied property, you need to be licensed to originate in some states.
Okay.
And there's other states that they don't care.
Okay.
But single family 1 to 4, owner occupied, license, anything else, you're on your own.
Okay. All right. Let's go to the next second part of that question. You're out of California, you're in Florida, and you're investing back into California as a trustee investor. What things should be considered? And it is a loaded question because this is kind of why I kind of moved away from individual trustees to more of a mortgage fund structure.
Well, if, for instance, to say that Florida does have reporting requirements, by the way, and however, if you are from another state and you're investing in California, you have reporting rules, reporting. At the end of the year, you have what's called a Form 881, which is a business activity report of all your loans that you had in California.
Yeah.
And how much did you charge for escrow fees and servicing fees and all this stuff. So all of that is you have to report to California. And that's outside
of the investor.
It's the broker per se.
Okay.
However, if you're the own sole originator, then you are the broker per se, right?
Yep.
You don't need a broker to do a loan. And that's a loaded question. That's a loaded answer as well. If you don't have a broker and you're doing loans, California has really strict rules on that as well.
Yeah, so you've got usury law. So usury being you can't charge over a certain interest rate. I think it was 10%. I could be wrong on that. I don't know if
10%, including all fees.
Yeah.
The APR has to be under 10.
Yeah. So, but then when we talk about fractionalized loans, when you're investing out of state, it becomes actually you need to be a registered advisor, if my understanding is
right.
It becomes, and I can't think of the term right now.
It's the blue sky rules.
Yep.
So you have to make sure that you are whatever state you're going to invest in. You have to make sure whoever's representing you.
Security. It becomes a security.
The security, right?
Yeah. So there are in the state of California, if you're a broker and you're doing trustee investments, fractionalized loans, you can actually you don't need to have it wouldn't become a security. But as soon as you start going out of state and bringing out of state investors into notes, it becomes a security.
Right. Yeah. So yeah, and there's for if there's any brokers out there that are doing originations, or if you, because you have to be a broker to do multi-lender loans, fractionalized loans. You can't just do it on your own, because it is a security, even in California. So as a loan originator, and you say, I'm going to, sell fractions of this loan to other people, well, you better sell the whole thing if you're not a broker.
Yeah. Okay.
Yeah.
Let's quickly talk about Dutch versus non-Dutch. What does that mean? I'm a Dutchman being a Vandenberg, but has nothing to do with my family background. So, right. But I do say, well, why do they use the word Dutch? What does a Dutch interest have to do with it?
Right. So this
what's Dutch versus non-Dutch?
This comes into play with construction loans or holdback loans, where so you do funding increases, right? If you are allowed to have the funds on your own, or if you don't want to charge interest on funds that the borrower hasn't drawn on yet.
Okay, so this is a construction loan, and let's say you went ahead and sent out 100,000 on the loan, but you're holding back 100.
Right.
You're only charging interest on that 100 day one.
On the 100, correct. And that's called a non-Dutch loan.
Okay.
So the minute that you make a draw, you call your servicer, you call us and say, hey, I just gave this borrower a draw of $50,000.
Yep.
And I'm going to ask you, when did you do it? Because I need to know the exact date that you did it. Because now interest starts as of that day that you actually gave them the money.
Yep. I hate doing non-Dutch loans. And the reason being is that, look, I'm committed to funding something in the future, and I need to get paid for that. So that's why first of all, I don't do a ton of construction loans. I do, we do fix and flip loans, kind of a quasi construction loan, I guess you could say, but we're always charging interest on that full loan amount because, again, I need to get paid for that liability that I have on my balance sheet as a fund manager. So that's something that we kind of stay away from.
Yeah, and it's
hard to, as a fund manager, to account for it. Like, you just don't know when that borrower is going to want that draw, and you better be prepared to have the funds available to give that disbursement.
So when it comes to that, I prefer, even if it's a non-Dutch loan, for you to have a payment amount on the full balance. That doesn't mean you're getting interest on the full balance. That means you're getting a payment on the full balance.
Okay.
So each payment on a monthly basis would be mostly, but there'll be some principal pay down on it.
Okay.
Because when it's a non-Dutch interest only payment, that puts a lot of work on us.
Yeah.
and we do charge an update fee every time there's a funding increase, but we have to recast that loan. And recast means where you're changing the monthly payment amount. It has to be in your note, by the way.
Okay.
That it allows you to, you start off with making payments on just on interest only.
Okay.
You do a funding increase that first month, it's going to be a prorated amount.
Okay.
And then the very next month, you have to recast it again, because now that partial month was a certain amount, but then the next month is a full amount.
Yeah.
It's a full amount, right? So if the servicer doesn't do that correctly, you're going to have what's called an unpaid interest bucket. And the borrower now doesn't pay the full amount. It goes to unpaid interest. Okay. So now we have to collect on that unpaid interest.
Okay.
Collect that unpaid interest to make
Am I allowed to charge interest on the unpaid interest?
If it's on your note.
Oh, interesting.
Okay. Now that comes into play where it's, and I'm going to throw out a term here, phantom tax. Phantom tax is where you collect interest on unpaid interest, or you decide to convert fees into principal.
Okay.
And all those things, when you start charging interest on unpaid interest or convert it to principal, that is earned income.
Even though you never received the money.
Even though you never received the money. You have to pay taxes on that. So and this is more when it gets converted to principal balance. However, charging interest on unpaid interest, you're in theory converting it to principal, because now you're charging interest on it. So what I tell the investors is, you can do the unpaid interest part. You just shouldn't charge interest
Yeah.
unless you're willing to pay tax on it.
Well, there's also some new regulations regarding what you can charge and can't charge in terms of default interest as well.
Yeah, that's a different topic altogether, but
Okay.
yes, and that's typically where the unpaid interest comes into play.
Okay.
It's in non-Dutch loans is one of them, and default is another one where you charge default interest and you allow them to make the regular monthly payment, but the default interest payment would have made it more.
Okay. All
So
right.
yes,
So
there is that.
let's jump ahead to non or performing loans. So you funded a loan, borrower is making payments for a good 6 months, seventh month rolls around, and they have not made their payment. We like to collect payments on the first. It allows us to quickly see if the borrower isn't going to make the payment by the 10th, which is our usually our grace period. So on the 11th, we immediately go into action. There's a letter that goes out, little nastygram that says, hey, go ahead and make your payment now, because if you don't make that payment by a certain date, this will be considered default, and foreclosure action is imminent.
Right. That is so. You as a loan originator, as your fund manager, you could do that. As a servicer, we actually do that for you.
Okay.
We do that what's called the late notice.
Okay.
Consumer purpose loans has even more regulations as far as late notice are concerned, because you have to do calls and 3 different days, 3 different time periods.
Okay.
But really the late notice is the key one, and our late notices will always put in that the lender has the option of now enforcing other rights that are in your note, which is foreclosure, default interest, stuff like that. And so you're giving them a notice with that late notice of that you can do these things.
Okay.
However, obviously, if you're going to do default interest or go to foreclosure, you still should do the notice of intent before.
Yeah.
And then the foreclosure starts after that.
Do you have a recommendation time frame wise, when you would start a foreclosure action on, let's say, non-payment?
You know what? It depends. But if you have a borrower who's had the loan for 6 months and they missed the first payment on the 7th month, I'm gonna say, you know what? Let's do loss mitigation. Let's do notice of intent. Let's call this. Yeah. Let's do some loss mitigation work instead of going straight to foreclosure.
Yeah.
Foreclosure adds a big amount of money into the equation, and that's just going to put them more in the hole. Now, if the borrower hasn't made a single payment, then you know what?
We're going. Yeah. Now, I always say, I like to give 30 days, right? And then that's when the process starts. Because good 30 days to have some conversation. What's going on with the loan? Why is the payment not being made? But I take a much more aggressive approach to servicing loans. I've always said that, underwriting is 50% of the game. The other 50% is the servicing of that portfolio.
Right. So like I said earlier, and we discussed, right, we do late notices.
Yeah.
We do late calls. And if that borrower, and I'll just give you an example. I had a borrower who actually we went to foreclosure on them. They never made a single payment. And at the very end, they said, oh my God, their property had gone appreciated in value a lot. So then they wanted to go to sale.
Okay.
They actually put it in escrow. And while they're in escrow, for the first 11 months of the loan, they never talked to anybody. But at the 11th month, they're already foreclosed. It's going to go.
Yeah.
And they start calling me. They start calling the lender, and they actually reinstate the loan. But it's already matured, so now you could still go to foreclosure. That doesn't stop the foreclosure. But they kept on talking to us, and you know what? It's in escrow. It's going to close any day now. We actually did like 3 foreclosure postponements because really you don't. I mean, it's my goal is to not have a foreclosure.
Yeah.
Taking somebody's residence away or investment away, unless they absolutely stop talking to you. It just depends on the person.
Yeah.
But yeah, if somebody's not reaching out to us, and all our late calls go unanswered, late notice go unresponded to, absolutely go to, let's go to
Yeah.
foreclosure. And usually that notice of demand, it gets into their system like, oh my God, and they'll start getting calls from people, because it's recorded, it's public knowledge, it's an
Yeah.
important county records, and you'll start getting all kinds of calls from other investors and other people like, Mr. Barr, your house is in foreclosure. Sell it to me. I'll take it over.
Yeah.
And
I
that
think one of
becomes
the things a lot of trusted investors also think that somehow they're going to get the house, right? It's always, well, I get, if he doesn't pay, I get the house. It's not like that. You get your principal back, you get your interest and fees back. That's what you earn.
right. So there's three things that the most basic of things when it goes to foreclosure.
Mhm.
This is a foreclosure talk, but I deal with it because when it goes to foreclosure as a servicer, I need to give the foreclosure trustee reinstatement calculations, payoff
Mhm.
demands, so that they know how to proceed with the foreclosure of what the amounts should be in the foreclosure for bidding instructions or for. So there's a couple of things. It reinstates at the very end. Well, actually, four things. They go bankrupt at the very end.
Yeah.
Or if it actually does sell to a third party, you are getting hold. Whatever's in the payoff demand, that third party is going to pay you every time that it's owed of you.
Yep.
Right. The fourth thing is it reverts to the lender. At that point, it is your house. And
But if it's being reverted back to you,
it's
it's not
because
good.
it's upside down.
Yeah, it's not good.
Right. Right. So you're right. If in the third scenario, it sells to third party.
Yeah.
You're owed $1 million and it sells for $2 million. Well,
Yep.
you're not getting that $1 million.
Yeah.
You're going to get your million, and that borrower is going to get that million difference.
Yeah.
So the borrower is actually, you're actually, the process is pushed along. They're obviously not going to get what they would have got if they sold it on their own,
Yep.
but they get the difference.
Okay. All right. So we're cutting a little short on time, but I did want to bring this subject up. I don't know if I told you I was going to bring it up. Seconds. Thoughts on second position loans? What has been your experience on servicing it? What have you seen from investors? Here's my thought. Seconds, I can never get out of. I've learned my lesson early. They just seem to constantly go and go and go, and you're constantly, which may be a good thing for some investors, that you're always extending the loan, but it doesn't. They never seem to end.
If you're investing in seconds, you better be really good.
Okay.
You better be really good. You better be on top of. You can't rely on, especially fractionalized seconds, which you can't do. But if you have a second, if they stop paying on the first, and that first forecloses on, you as a second, you're wiped out potentially. You could be potentially you're out nothing. You're going to lose everything.
Yep.
So as a person investing in seconds, you better be on top of your game. You better be ask for your borrower. You know what? Payment statements on your first, and that could be part of your notes. Say,
Yep.
if you don't give me payment statements on the first, I could go and foreclose against you right away.
Yep.
And you better be
so
prepared.
let me just define seconds, because there may be new investors. When you invest in a second, you essentially there's a loan already on the property, and you're putting a loan that's behind, we'll call the term is subordinated to a first. And so all payments go to the first in order to keep it current, and then any payments go to pay the second in a sale of the property.
Right. I was
in
going
the
to say
sale
that.
of a property. But that means that you've got to that first has to be fully satisfied before you get any proceeds from the sale. And that's what complicates the matter, because if the first forecloses and they accrue a bunch of expenses, well, there may not be enough proceeds from the sale to pay down your second.
Correct.
Yep.
As a first, you want to be able to, and a LTV.
Yeah.
You want to be able to have enough equity in the property, so that if they stop paying, if it goes foreclosure, you're going to get paid in full. As a second, you better make sure that equity covers the first and the second.
Yeah.
Because it's second, investing in seconds, you have to know what you're doing.
And that term is called combined loan to value. So when you add up the balance of the first, the balance of your second, combine those two, Okay, and then divide it by the value of the property. It's called combined loan to value. So people think combined loan to value at 65% with a first and second is just as safe as a combined of a loan to value of first. If you just have a first position at 65, and that isn't the case, because you can quickly lose that equity position very quick. So that I don't want to get too far into seconds. I didn't mean to get into that, but that's why I always suggest if you're investing in trustees, definitely don't, or you're just starting, I wouldn't recommend jumping into seconds. I know the returns look attractive and the loan to value looks attractive, but you're going to get burned. And it's very quickly you can go from making pretty good money to just losing the money.
Our company doesn't do senior lien tracking, but there are some services that do senior lien tracking. And that's an added cost. And it's just, and it entails every single month calling the first, and you have to have authorization. So yeah, we don't do that. But yes, if you're not gonna do it yourself, then you better have somebody does it for you.
Okay. Well, Enrique, I'll tell you, we're coming to the end of our session here. I want to say, first off, thank you very much for agreeing to come on and giving us some tips on and some insight onto loan servicing.
Thank you. Thank you for inviting me again.
Yeah. So just real quick, can you let everybody know a little about your company? How can they contact you? And yeah, go ahead and tell people.
Right. So as I mentioned briefly, I used to be the president of a couple companies. I decided to go on my own and created Servicing Pros. My goal, as you said, I'm more of the calming kind of guy because I'm an accountant by nature, and I love data. I love queries, and by that, and I don't love queries just for the number's sake. My queries are more for if something wrong here, right? So that is really what I'm looking for, and to be able to report. So as an investor, our portal is geared for either a lender or a broker, and I'm always taking it, like, hey, why can't I see this? Oh, perfect, I'll do this for you. I have construction holdback loans. Oh, I'll do this for you. So that is really what I'm looking for. I want that investor to have as much information as possible, and they can go through it, or they can just call me. And
I'll say that, Enrique. I mean, there's only a couple of servicers out there that provide the service that you provide to trustee and mortgage investors. And there's some 800-pound gorillas out there, and then that we all aware of, and but I think what you offer is such a customized level of service that I can pick up the phone and get you on the phone, and if I had any questions about a loan.
Correct. That is really the key. And those 800-pound gorillas, somebody actually told me at the convention, like, do you want to be like them? I go, absolutely not. Because you lose sight of what you're doing this for. You just, it's not. So that's where I'm at. So Servicing Pros, you can go to our website, servicingpros.com.
And what's the best phone number to reach at?
877-313-0095.
Wonderful. So what I'm going to do is we're going to go ahead and download the recording. I'll go ahead and send out a quick email thanking everybody for attending the webinar today. I'll go ahead and put Enrique's contact information, and please use Enrique as a resource. I find him very knowledgeable about the industry. There's so few people that have been in our industry as long as you have, and that just goes to show that what you've done well. So it's tough to stick in an industry for a long period of time like you have. Even though I think you're lying about 1987.
Yeah, my broker license started with 00. Now it starts with 02, which is over 2 million licensees.
Wow, well, cool. Well, Enrique, thanks again, and I'll go ahead and get that email out.
Right, thank you.
Bye-bye.
Bye-bye.